Good afternoon. Welcome back. We get into some fun things now. Remember when we first started, we talked about we wanted to protect your assets, but we're protecting them against 4 different possible sources that will drain your assets away. Number 1 is the creditors. We just talked a lot about some simple things we can do to make your assets so they're unavailable to creditors. So now the second one that we talked about is excess taxes. Okay, so let me tell you, first of all, this is my theory about taxes. Taxes are necessary. I understand that. I use the roads outside. I have policemen that come to my house if somebody's robbing me. Somebody else is fighting over in Afghanistan. I don't have to do it. I'm willing to pay for those things. If nobody paid taxes, our country would be like the goose that laid the golden egg, but somebody sat there and chopped his head off to get all the eggs right now. It's not going to lay any eggs anymore. It doesn't give us any more benefits anymore. So we need to keep it alive. And how do we keep it alive? Paying taxes. That's the food we're giving. Now, I agree. Sometimes our goose is a little bit fat, okay? And that's the way it is right now. But the deal is we can go ahead and have more control over what that goose is going to get from us in compared to what he's getting from others. So that's what we're going to talk about now for a minute, okay? About what kind of tax benefits we can come. And this one's going to be in several different parts because there's so much to look into this that it's going to take us a little bit longer to go ahead and get through all the different options. So let's first of all start, what is the foundation of our business structure? And we're just going to sit there and figure that our business structure is basically the corporation, the limited liability company that is the general partner of our LLC and our FLP and our trust. So we've got basically 4 entities in a simple business structure. Are we going to get any tax benefits with the LLC? No. Remember, that's the one in Wyoming. The only purpose we have the LLC, Wyoming LLC, is in order to make sure that if somebody's going to sue us, that's what we're going to throw to the dogs. That's what they get to go after and chew on and try to get something out of. That's the only purpose. No tax benefits. There'll be no money flowing in to that LLC. There'll be no money flowing out or expenses paid out, okay? All expenses for the LLC will be taken care of by the FLP. So then let's talk about, how about the trust? Do we get any current tax benefits from the trust? And the answer is no, not really. The fact is it's not set up to be able to be a tax haven. It is set up to make sure that things go properly to our family after we're gone. Things continue to get controlled if we lose capacity, and we're able to make sure that things go as they should in as easy and a tax-free way after we're gone. So during our current life, we're not going to get tax benefits from the trust. As we mentioned before, after you're gone, we can get tax benefits having to do with capital gains tax, with gift tax, with estate tax, and different things like that. And when we get into some more planning with trusts and estate documents, we'll get into that and show you exactly what we can do there. But for the moment, we don't have that to get any tax planning. So what do we have left? We have a corporation and we have a family limited partnership. So let's talk about the corporation first, okay? So you've got this corporation and you're selling widgets, okay? And so every day you're out there selling widgets, and when you sell those widgets, the money comes into the corporation. That's called income. And it comes into the corporation from all the different the different customers that we would have who want to buy our widgets. So now what happens is before we sell the widgets, we have to buy the widgets from somebody so that we have the widgets to sell. So we have an expenses that we have to pay out of the money that we're receiving from the widget sales. And so we pay the manufacturer, we pay for shipping, we pay for employees, we pay for taxes, we pay for all the things that have to do with a business. So we have money coming in and we have money going out, okay? And that's normal business. Now the goal is, with a successful business, you want to have money left over after all that happens. If we have X coming in and Y going out, we want Z left over. Because if there's no profit, why are you doing this in the first place? Why don't you go and live on a beach in a tent? Because you're not making any money from this anyway. So the deal is we want to make sure that we have some money left over. So now what happens to this money? Some of it goes to you or your spouse as income, okay? A salary of an hourly wage, some way that they get paid, you get paid for doing the work. And that's great. Let's just say for the fun of it that you end up where you're able to comfortably take home $10,000 a month. All right, and we'd like $10,000 a month, and you go home to your wife and you stick out your chest and you say, guess what? I'm going to be bringing home $10,000 a month. And your wife says, oh, you're my hero, $10,000 a month. And then she gets the check and it's only $6,000. And she says, just a minute. We have a problem here. You said I'm getting $10,000 a month and I only got a check for $6,000. And you say, well, what happened there? And you look at the check and the check says, oh, before we actually made the check out to you, we paid 7 types of taxes, okay? And by deducting all those taxes, you only end up with $6,000. And I'm using the 40% tax rate because overall, anybody who's out there doing anything is basically at least in a 40% tax bracket, okay? And that's not just federal, that's state, that's workers' comp, that's unemployment. There's all these different type of taxes that they're going to take out. So the deal is she gets $6,000, and so your lifestyle's a little bit lower than what you thought it was going to be. You're thinking get $10,000, we're going to go on trips around the world, we're going to go do all these things, and now you stay at home and eat beans. So the $6,000 is fine. We're okay with that. But what if instead of paying yourself $10,000 and having $6,000 coming out as taxes, what if you only paid yourself $5,000 and you put the other $5,000 into your limited partnership? Now the $5,000 going to you, you're still going to have tax on it, 40%. Well, you got about $1,500 in taxes, and so you're going only up with $3,500. But the other $5,000 goes into the limited partnership, and it's never taxed yet because it's to pay for services provided. And so the deal is, you now have, instead of having only $6,000, you have the $3,500 plus the $5,000. That's $8,500. You've already saved that much. There. Now, when it's in the limited partnership, okay? And I understand. I have to tell you this. My wife needs to have money to spend, okay? She has to buy things for the grandkids. She has to buy things for the kids. She keeps me clothed. She feeds me really well. She just takes care of everything, and so she gets that check. I don't ever look at that. She spends it any way she wants, and it's good for her, okay? And so we came up with the idea that that's how much she needed is a specific amount, and that's what she gets. The rest of what I'm supposed to get, okay, because I own my own corporation, I get some control over where things are going to go. I have it go into my limited partnership. So now, in my limited partnership, I've got some rentals that I'm getting some rent on. I've got some promissory notes that I get paid on the promissory notes. I've got in my investment account, so I'm getting some increase on those investments. And so I'm having money coming in from what's in the limited partnership. I have money coming into the limited partnership from these agreements that I have with my corporation. Now, at the end of the year, the corporation is going to end up with 0 tax. Why? Because by the time I find out what needs to be taken out of there to make it 0 tax, I'm just going to bring it all into my limited partnership. Now, why do I do that? Well, the corporation, when we create the corporation, or when it was created for you, there was a document called an SS4 that we had to send to the IRS. And we had to tell the IRS, this is what we're doing. And in exchange for us telling them what we're doing, they're going to give us a tax ID number. And so in that document, such as for my law office, I had to say, we're going to provide legal services. So they know that that is the purpose of my entity. That's what we're going to do. So now what happens is at the end of the year, when I send in my tax return, they pull up my SS4. They don't really do this, but it's kind of done by the computer. So they got my SS4 says, this is what they're doing. They pull up my tax return and say, what are you deducting? And they say, okay, you're deducting for your employee expenses. Yeah, that works with a corporation, with a law corporation. Paying taxes, that works with a law corporation. Paying some travel expenses, that works with a law corporation. A boat doesn't work with a law corporation. There's just not a reason to have a boat unless you're going to have meetings out on the water, I guess. But that's not what I do, so that wouldn't make any sense. So they say, just a minute, this boat, that's kind of giving us a problem. I think we need to go and audit this guy to see what he's doing, okay? So do we want to be audited? No, okay? Are we scared to be audited? No, not if we do everything legally, right? But the deal is, an audit's a pain, whether it's you're in the right or the wrong. So the deal is, we don't want to be audited. And so why take that chance by deducting something from our business, but it has nothing to do with that? So what we do now is we say, okay, we're going to transfer the assets, the extra monies, down into my limited partnership in exchange for being the property manager or being the marketing director or doing accounting, or for being a wholesaler for our corporation, or whatever it is, renting assets to the corporation. That's what mine does. And so the deal is that that excess money comes down, the corporation's up with a zero tax, and when they compare that, they're going to say nothing was paid out that is inappropriate. But now we have the money in the limited partnership. So what are we going to do with that? Well, the limited partnership, we had to file an SS4 for that one also. But this one, when we told them what we were going to do, it's different. Our limited partnerships, this is just a piece of it, but it basically says that our limited partnerships are able to hold and lease real and personal property. Well, real property means anything attached to dirt, okay? Personal means it's not attached to dirt. It can still be dirty, okay, but it's not attached to dirt. Leasing it means we can have something and we can actually rent it out. Like if I had a boat, okay, I could actually, if I had the boat, I can lease the boat from my limited partnership or hold it. What if I have a Rembrandt? Okay, and so the Rembrandt, I'm just going to hold it and let it go up in value. So all of a sudden, the ability to deduct taxes are muchly expanded from what my law office can do. So now all of a sudden a boat works, an airplane works, okay, my tractor works, okay, I can start collecting or dealing in things like gold bullion or silver bullion. You have to actually give yourself permission to do that, but the deal is you can decide what it is your limited partnership's going to do, and all of a sudden many of the expenses are going to be on having to do with all those things are tax deductible. Now we're going to show you in more detail next time how we use this money that's now in the limited partnership in a tax deductible way, okay? I know it's going to be hard for you to wait for this next one, but this is going to be really exciting, and this is the one where I have people jumping out of their seats when they find out what they can start doing with this money that has not yet been taxed. It's pre-tax money. That's what's on the schedule next time. So we'll see you soon.